working model, right? So this is a very, very important point because 90% of students fail to match the balance sheet, and that is very, very important when you prepare a financial model. Because if you can't create a working model, then it means you certainly there's a gap in your skills or in your understanding of financial or technical concepts, right? So please focus, complete 100% focus on this point and make a note what are I am going to discuss today, because that will clear all your doubts and confusion, and you can easily match this balance sheet, right? So when I say creation of working model, so it's nothing but is three statement linking. You must have read in your studies like we have three statements: income statement, balance sheet, and cash flows. All these three statements are linked with each other, right? So within income statement we have net profit that goes to balance sheet in within equity sections, and then balance sheet and cash flows are linked where cash from cash flow statement goes to balance sheet, and then that's how balance sheet is matching. Other things are quite easy in this linking. The only thing is creation of cash flow statement, because cash flow statement is quite complex task, and that's why you need a very in-depth understanding of technical and financial concepts, right? So today in this part we are going to learn how to create this cash flow statement, and then we will link it with balance sheet, and then you will see balance sheet is matching completely, right? So we'll go to this cash flow statement. As you can see, this cash flow statement is filled. Now what we will do, just to create a fresh, I'll remove all data from here, right? So now I have removed all items from this cash flow statement. So if you look at, so this is there, that's the linking that I have plugged in this cash number from cash flow statement. So I will also remove this number, right? And yeah, so if you look at now, balance sheet is not matching. This is a gap that we are getting. That's because cash number is not linked, and our cash flow statement is completely blank. So now we need to create this cash flow statement. Friends, please note that for creation of cash flow statement, you there are two things that you must focus on. All from the income statement, there are only two items that will come in the cash flow statement. The first one is net profit, that is profit after tax, that this is the thing. Second is depreciation and amortization. These two items will come from income statement, and rest of the items will come from balance sheet, right? So please focus on these 2 points. These are very, very important to understand. Only net profit and depreciation and amortization will come from income statement, and the rest of the items in the cash flow will come from balance sheet, right? And when I say all items in this cash flow will come from balance sheet apart from net profit and depreciation, please note you should link each and every line item of the balance sheet with cash flow. Then only you will have complete impact of each and every change in the balance sheet line item, right? So here in cash flow, basically we are trying to understand how much cash the company have, right? So here we will record all the changes that has happened in the balance sheet and whatever cash that we have got from the earnings, right? So as I said, two things that will come from income statement, that is net profit and depreciation. Now let's start linking. So first, as I said, profit, that will link it from income statement. So this is profit after tax, and this we will link it here. And second is depreciation. We add depreciation because this is a non-cash charges. So cash flow is not going out of the business. So that's why we have to add this depreciation and amortization here. Right? So we have added these two items from the net income from the income statement. Now we have to link each and every line item of balance sheet. So first we will start with this working capital. In working capital we have two things, current assets and current liabilities, right? So first we'll link all current assets. So when you link current assets, we need to record only changes, year on year changes, because that shows whether cash is going out of the business or it's coming in, right? So we need to record only changes. So when you link any assets, right, then increase in assets means cash is going out of the business, right? And increase in liabilities, that means cash is coming in. So always remember this thing. When increase in asset, that means cash is going out of the business. And when liability is increasing, that means cash is coming in. And we have to record this change accordingly. So when I say need to link assets, so increasing in asset means cash is going out. So always record this previous year minus next year. That will take the sign automatically whether it's plus or minus. So record, please note, previous year minus next year for all assets. So when I inventory, so previous year minus next year, and that will record. So that's increase in, so cash is going out of the business, that's why it's negative, right? And after that we have receivables, advances to suppliers, trade payables, advances. So these three is inventories, receivables and advances to supply, these three are current assets, and these two assets are also below the inventory. See, receivables and advances to supplier. So what we can do, we don't need to link again because our formula is consistent. We can just drag it down, and our receivables, advances and suppliers changes are already reflected, right? So we don't need to link. That's the benefit of a single formula in a row. And if you have consistency across model, then it's very easy to update, right? So we have linked now current assets. Now we needed to link current liabilities. So change in trade payables. Now we'll look at trade payables. So here it is current liabilities and trade payables, right? So when I say, so for liabilities, you need to do just opposite what you have done in asset side. So next year minus previous year. Here it is done, right? So we have recorded the change in trade payables. If you look at the below, we have other current liabilities, short-term provisions, and deferred tax liabilities, right? And then you look at these all four items are in current liabilities, other current liabilities, short-term and deferred tax liabilities. And we can record, we can just drag it down and our impact will be recorded here. So we have seen change in trade payables and current liability, and there's no change in short-term provisions and deferred tax liabilities, right? And this is total non-cash working capital, right? We don't link cash because, and cash is the balancing number that we are going to link, that will come from the end of the cash balance from the cash flow statement, right? So this is the linking of current assets. Now these are the non-operating adjustments that I will come after once we are done with this cash flow statement. This is again a very critical thing, but it will not have any impact on the cash flow cash number. But I will come later on this part. That's why I have highlighted this part in yellow color. Now our cash flow from operating activities is done. Now we need to create for changes within cash flow from investing activities. Now capex. So capex basically, uh, what is the capex that company has done? So again, it's going into asset side. So we'll see previous minus next year, right? Assets. So here we'll see this is a gross block. In the gross block, all capex is added, right? So we'll see how much is the capex. So previous year minus next year, and this is the capex that company has done in FY13, or that is planning to invest. So here it is capex number for each and every year, and then similarly increase in investments. So here it is investments. Yeah, this is fixed deposits, and here we have got our cash flow from investing activities. And now next part is cash flow from financing activities. So here we have to record all whether we have raised debt or equity, or have we paid any debt amount or something. So we have to record this change in this section. Now first part is equity. So look at equity section. This is equity capital. So here we will link it. So it's liability side. So we need to just oppose it. Next year minus previous year. Right. And similarly, the short-term debt and long-term debt. Short-term debt, it's part of current liabilities, and similarly for long-term debt. Right. So now we have linked each and every line item, and here it is cash flow from financing activities, and this is net cash flow. And now we need to link our opening cash balance. So this opening cash from FY12, I will. So this is linked with your FY12 cash state, this balance sheet, the cash that they have, right? So we'll link it. This opening cash is last year closing cash is current year opening cash balance. So this is a opening cash, right? So we'll drag it right, and this is done, right? So here is our closing cash. Now we will link this cash in the balance sheet. See, this is not matching right now. Once if we link it, then this check should be zero. So now we have linked it. Cash, see, there's zero, right? There's no difference is coming. So that means our balance sheet is matching. There's no error, right? So this is perfectly linked, and that is the process that you need to follow to match the balance sheet. So two things to remember. One is there are only two things that will come from income statement, that is your net profit and depreciation and amortization, and the rest of the items will come from balance sheet. And you need to make sure that you link each and every line item of the balance sheet in cash flow. But remember two things, that the first thing is regarding the gross block. The capex that you compute, that should be based on gross block, not on the basis of net block. If you compute on net block, then it will have impact of depreciation, because depreciation we have already added at the top of the cash flow when we added depreciation from income statement. So right, just to record a only capex number, you just need to decide that change based on the gross block. Second is this equity section. In the reserve and surplus, we have added net profit, right? So we should not consider this. We should only consider only the change that if we have issued any equity or any buyback, right? So that's how we have completed this exercise. And now we'll focus on the third point within this, these non-operating adjustments. So friends, non-operating adjustments are very important to compute the correct cash flow from operation activities, because that is what shows how much cash the company has generated from its operation. Because at the moment it includes couple of non-operating items, that's why it doesn't show the true picture. But if you make these adjustments, it will not have any impact on the ending cash balance, right? This cash, because at one point you will have a plus impact, then on the other side you will have minus impact. Therefore the final impact will be zero of these non-operating adjustments. But you should have these adjustments so that you will have a correct figure of each and every activities within cash flow statements, like cash flow from operating activities, cash flow from investing activities, and the final cash flow from financing activities. Now, so where are these non-operating items? So if you have noticed, we have started this cash flow statement from profit after tax, that is net profit. And net profit has come after adjusting all non-operating items as well. So now we have to look at income statement and see what are the non-operating items. So this is income statement. All items before EBIT are considered as operating items. That's why we call EBIT as operating profit, right? Now if you look at items after EBIT, this one is interest, other one is other income, and the third one is tax. Tax is not a non-operating thing. It's a operating thing because we have to pay tax on our earnings, right? So we have to use tax. So this is not adjusted. Now what are the remaining non-current things? First one is interest paid and the second is other income. These are the non-operating items. So we have to adjust these two items in the cash flow statement. So here we have subtracted interest and we have added other income, right? So we have to do other or just opposite of this. So in the cash flow, as so here we have to add interest because there we have deducted, right? So we'll add interest. Similarly, this non-operating income, in the income statement we have added, here we have to deduct it, right? And we will just drag it on the right side, and this is linked. Now, so this is our the right cash flow from operating activities. That is the true cash flow from operating activities, and that we can show in our statements, right? And now, as I said, these non-operating adjustments will not have any impact on the ending cash balance. So as we have adjusted these two items in the operating cash flow, we must have the opposite impact in the cash flow on the other line items, right? So let's look at it. So the cash flow from investing activities, right? So as I said, non-operating income that we have adjusted here, basically it's operating non-operating income generally the company has generated from its investments. So it's part of investing activities. So here we have deducted, we will add it here. So just to have opposite impact, right? In a similar way, this interest is part of financing activities because the company pay interest on its debt, right? So here we have added and we have to deduct it here. So the overall impact of this item is 0, right? So we have linked it and this is our final cash, and if you look at our balance sheet, it will also match. So there's no difference. So our income statement, balance sheet and cash flows are perfectly linked. And here is the final valuation, right? If you change anything in the model, this will have an impact on the valuation, right? So just look at it. So income statement, there are three different scenarios for revenue. So at the moment we have this revenue model based on neutral case. If you change this to optimistic case, then our valuation will also change. See, our valuation has increased from 170 to 231, right? Now see whether our balance sheet is matching or not. See, our balance sheet is also matching, right? So if we change anything in the model, it will have link or impact everywhere in the model, and it's perfectly linked because there's no error, right? So that's how we need to create the model. And here we come to our end of this webinar. So we have covered two topics. One is best practices for financial modeling, and the second that we have covered is creation of working model. So friends, these two things are very important for any financial modeling setup. So please, hope all of you have noted all the important points, and if you have any doubt, please let me know. I will be very happy to answer all of those questions.